So if you've ever wondered what all the different business types are in the US and which one's best for me, then you're going to want to watch this video. Hi, my name's Cameron and I run a bookkeeping tax accounting firm where we help individuals, business owners, digital nomads, influencers win at the tax game and structure their businesses and life in general best way possible so they can reach their goals. And in this video, we are going to talk about the different types of business structures and what you can be and what you should be, and benefits, pros and cons of all of them. So the most common different types of businesses in the US are sole proprietors, partnerships, LLCs, S-Corps, C-Corps, and then you have nonprofits. And each of these different types of businesses can have different benefits, whether that's tax treatments, liability protection, maybe even if you're trying to get investors, there's different reasons why you would choose each different type. And so before you just go into business, a lot of times you have to think about what is my goal here doing that. And so a typical type that you might have is sole proprietorship. So a sole proprietor is the default business tax classification or business type that you are, whether you just start driving for Uber, or maybe you start getting paid to be a photographer, or you do design work on the side and someone pays you. Immediately, if you don't do anything and you just get paid, you're a sole proprietor by default. A sole proprietor is nice because it is super flexible. You don't have to do anything. You can just take money and that's it. So as a sole proprietor, even though it's that easy and flexible and you can just open up a bank account in your own name or just use a bank account that you have and just start collecting money and that's that, it gives you no liability or asset protection. So hypothetically, if you're a photographer and you go to a wedding and you take a picture of a bride and the bride thinks you made her look fat or something, then she comes and she wants to sue you. Well, then if you have a house, a car, any assets, investment account, technically they could come after all those other assets that you have because there's no liability protection. Number two, the way to look at it is from a tax perspective. So a sole proprietor, you're taxed at with the full self-employment tax, and self-employment taxes are Social Security, Medicare taxes, and it's 15.3% on top of your federal income tax. So as a sole proprietor, if you make $100,000, you are going to pay the federal income tax plus 15.3%. So from there, from a tax optimization perspective, the sole proprietor isn't necessarily the best way, but it does make sense specifically in the beginning when you're just starting out, when you're trying to figure out your business. It's just easy to do that. The sole proprietor is the most common type we see when people come to us as clients, but it is also, because it's so flexible and so easy, that a lot of people just commingle funds. So they're just going to be receiving payments for, let's say, being an online consultant or coach or whatever. They'll just get all that money in their bank account, and then they'll also just go immediately spend it on, Zara or Louis Vuitton or whatever they're buying, makeup, whatever they're buying, and immediately from the business account spending on personal things. And that's a big no-no. Even if you are a sole proprietor, you want to make sure you're separating business expenses from business expense, personal expense. Keep them separate. One, from a recording standpoint, it is easier to track, so you're not at the end of the year just trying to kill yourself trying to go through it all. And two, if you are ready to make that step into an entity, which we'll talk about which type of entities, then you already have a bank account and you've already been establishing good habits to make that transition. So a sole proprietor can be great, and we recommend that people stay sole proprietors until you get that 50 to 60 grand of net income. Where you report your sole proprietor income on your tax form is on form Schedule C of the 1040. So if you're doing your taxes by yourself, which we don't recommend if you're especially good in the business, but if you do, then you totally can research everything. You just go on, if you're using TurboTax, you add Schedule C, you put on all your revenue, all your expenses, and that's where you record that. So yeah, so as a sole proprietor, super flexible, doesn't get optimal tax treatment, but is what we recommend until you're that 50, 60 grand of net income. The second one is partnerships. So partnerships, it can be really intricate and complex. We won't go too much in depth in this video, but basically there's different types of partnerships. You typically have a general partnership, a limited partnership, and then sometimes you can have a limited liability partnership. But typically, if you're just a general partnership, say me and my friend, we want to start a business or something, and we just want to collect, let's say we do taxes, and me and my friend, okay, we're going to charge you a fee to do taxes. We're just going to be general partners. And basically, general partnership is basically like a sole proprietor because in the sense that it gives you no asset protection. Sometimes when general partnership might make sense is if you are buying rental real estate, we've seen, or houses or something, and you don't want to register anything anywhere. You can just say, so my name's Cameron, let's say my buddy Xander, and I want to buy a piece of property. We might put CZ Partners, and we could buy that, and the deed is there, and when someone looks up the house, they'll just say CZ Partners, and they'll be like, who's that? Now, obviously, if you hired a private investigator, you could find them, but it just adds another layer. So partnerships can be good if you just want flexibility. Again, super easy to set up. You don't have to register anything anywhere, and it doesn't offer you the liability protection. Now, some people might say you can get insurance to protect that and layer it like that, which is true, but it's always nice if you have that extra layer to have an extra entity, and it's worth the extra steps in the end if that's the case. So yeah. The partnership can be flexible, especially limited partnerships. You can really shift who has more liability and stuff. Now you're looking more into an attorney. That's more of an attorney question. But what you need to know is that it offers not much liability protection, doesn't give you any favorable tax treatment most times. And then where you recorded on your tax return is you would have to file a 1065 partnership tax return. So it's a separate tax return from your individual 1040. You have the 1065, it's just the information return, so you don't pay tax at the partnership level federally, and you file that, and then you get a K1 that you attach to your 1040. So that's that on partnerships. Most clients that we deal with, and if you're watching this video and you're one of your clients, you probably won't be using that structure, but it's not out of the realm of possibility. The next one is LLC. You've probably heard of that. LLC, get an LLC, which is limited liability company. And an LLC is nice. It is flexible. It's super simple to set up a lot of times. You can go online and you get bombarded with advertisements from, LegalZoom or LegalDoom, we like to call it, or other just cookie cutter websites that will, form it for you super fast, but they don't really offer anything else. And the benefit of that is it does offer liability protection. So you do get that protection. So like I said in that example earlier, if you're photographing someone and they decide to sue you because you made them look bad, they can only come after the assets in the LLC. So if I'm a photographer, you won't really have much assets, maybe besides some camera equipment and then cash. So if I've got $100,000 in my bank account as a photographer, they could only come after that money and take that. They couldn't come after if I have a house or a car because it's protected. Now, with an LLC, one thing you must know is that it does not offer you any tax benefits. A lot of people get this wrong. We see a lot of clients come to us and they're like, oh, I got an LLC. Now I'm winning at the tax game. No, it doesn't. From a tax perspective, an LLC, if you're a single member LLC, if you have multiple members, then it's just like your partnership. A single member LLC, which is a common one we see, offers no tax benefits. So you are taxed the same as if you didn't have it. You're taxed the same as a sole proprietor. So that means you're still paying that full self-employment tax at 15.3%. But what the LLC does offer is that asset protection. And so that's why a lot of people do it. So we don't even recommend people get LLCs unless you're in like a super riskier business. But if you're just starting out as a photographer or a coach or a consultant or a designer or some service business that's in marketing, we don't recommend an LLC until you get to that 50 to 60 grand of net income. So income after expenses. And then we would set up the LLC to become an S-Corp. And we're going to get into S-Corp next. But the LLC, what we want you to know out of this video is that it does not offer you any tax benefit. I don't know where people got that idea from, maybe on the internet and stuff, but it does not. So it does offer you liability protection, which is great. You must operate the LLC properly because a lot of people will set up the LLC and then they might not even set up a bank account for the LLC. So you got to set up a bank account in the LLC's name with the EIN, the LLC Articles of Organization. You should have an operating agreement, which most people don't, but you should get one, whether that's just a template or something that shows basically the operating agreement is like the rule book of the company. Basically sets the rules, like if there's new owners or if you want to shut down the LLC or if something happens. As a single member LLC, it's not as important, but especially if you add members, it's crucial. So yeah, you need an operating agreement, whether you just get a template online or you have an attorney draft one for you. you need to make sure you have the LLC bank account, because a lot of people will set up the LLC, then they don't set up the bank account, they keep using their personal one. And then part two is you might set up the bank account and you might use it, but you might start using it, but then you also have personal expenses from that. And that's a big no-no. We want to keep that separate, because people are like, oh, I know. And I know a lot of you know that you have to do better. And I get it. It can be hard. And every now and then I get one or two transactions that slips, and that's not the end of the world. But when it's consistently week after week or month after month, day after day, like if something ever happens, you're not going to have that protection that the LLC benefits. So the biggest problem with, mixing, which you might hear, like mixing personal and business expenses, is that if someone ever, looked into it, or you ever got sued or something, they would immediately dissolve. It's called piercing the corporate veil. And basically they would look through and be like, well, clearly you're not operating this LLC like a business. You're just using it like a personal bank account. So all the benefits of having the LLC are basically wiped away. And so they're just going to pierce the corporate veil and look through it and basically be like, well, clearly this doesn't offer any asset protection because they're not using it like that. So if you're not using it, if you're mixing a bunch of personal expenses with business and you have an LLC, stop doing it. I know you need to. And if you want help with it, come talk to us, because a lot of times we're like financial therapists here. And it starts with baby steps to start getting in the habit of separating. But once it's separate, one, you'll keep that asset protection and all the benefits of LLC like you wanted. And two, you'll have easier record keeping. The bookkeeping will be a lot easier because you're not just taking about a bunch of distributions and paying yourself like that. And in another video, we're going to talk about how to pay yourself as an LLC and all the different types of entities, but not in this video. We're just talking about each type and what it is. So an LLC, single member LLC, you report that on your Schedule C on the 1040. It's just, you're taxed the same as a sole proprietor. The federal government doesn't even really see it from a tax perspective any different way. If you have multi-member LLCs, so more than one member, then you would file a 1065 partnership return, and then you get a K1. So an LLC from a tax perspective offers no benefits, but it does give you that liability protection. So that's why sometimes people do it. And if you want to use a different name, so I really like to eat acai bowls. So if I want to operate as, instead of my own name, Cameron, and I want to operate under We Love Acai, and that's my business, and my business is, we make acai bowls, and I want to operate as We Love Acai, well then I would need to either file a DBA or assumed name in order to be able to market myself using that name, or I would file the LLC as We Love Acai Bowls LLC, and then I can use that name. So that's another benefit of the LLCs. You can use, whatever name you file it as, you can use that name rather than just your own name. Because as a sole proprietor, you cannot. You need to, if you're going to use something different than your own name, then you would have to file an assumed name or a DBA. So that's LLCs. The next type of business, some might say is not even like a real entity, is called the S-Corp. And so the S-Corp it's not a business entity per se, it is just a tax election. So how you create an S-Corp, and you probably heard on the internet, S-Corps are great for tax savings, which they can be in a lot of situations, but sometimes they can be over-marketed, is you create an LLC, or you create a C-Corp, a corporation, and then you file Form 2553 to make the tax election that you want to be seen as an S. You make the S election to be seen as an S-Corp. So what you're basically saying is you create an LLC, and then you tell the government, the federal government, I don't want you to tax me like an LLC or a C-Corp. I want to be taxed as an S-Corp. And the government, you file this form, the government comes back, and they're like, oh, okay, great. We'll tax you like that. We'll see you like that. And so if you do set up an S-Corp, a lot of times the main benefits of an S-Corp is that you save on the self-employment tax. So like I mentioned before, you have 15.3% tax that you have to pay as a single member's LLC or a sole proprietor. It's a Social Security Medicare tax. An S-Corp says, well, you don't have to pay that full 15.3%. You only pay that on the payroll amount that you take. So as an S-Corp owner, and we see a lot of people do this, you have to take what's called reasonable compensation. But there's different ways technically you could get reasonable compensation. And there's a lot of different factors and things people might argue with it. Some people say, oh, just take a third of your net income and that's reasonable. So if you make 100 grand in net income before you're an S-Corp, you would take $33,333 salary. I think I said that right. So yeah, you would take that as your salary, your reasonable compensation, and then that remaining would not be subject to that 15.3% taxes. So that's where you save in this example. If you take a salary of an S-Corp of $33,333, and then you pay the full 15.3% tax on that, then that remaining $66,700 and I believe $77 would be no 15.3% tax. So this is the scenario that one with the S-Corp in this scenario on 100 grand of net income. 100 grand net income as a sole proprietor, you're going to pay $15,300 on the self-employment tax. But as a S-Corp, you wouldn't pay that much. You would pay significantly less and save thousands of dollars. And you can see the differences right here. But so that is where the value of the S-Corp comes in, is you save on the self-employment tax. And that is why we recommend to a lot of clients to do it. Now, the crucial thing is to take a reasonable salary, a reasonable compensation. Taking no salary is a huge red flag to the IRS, that you're going to most likely get audited, especially if you do it multiple years. So we see a lot of people, they don't take a salary and then they're like getting the maximum benefits, because that would be nice if you could just not take a salary. But the IRS obviously clearly doesn't want that because you're getting around the system. We've seen you can do like really in-depth studies where you might go on, where you can pay us or someone a lot of money, like $900 to do like an in-depth audit-proof reasonable compensation now, and see where it factors in market rates, your time you put in, the role you're doing, all the different factors, and then it spits out a number, and that's your reasonable compensation. Now, a lot of times that's maybe not necessary, but you can't have that done if you're like, I just want to get audit-proof no matter what. Two, another way people might do it is they go on Glassdoor, Indeed, and look at the salary amounts average in their city or area for the role they're doing. So if you're like a photographer, you might be like, okay, photographers in Nashville. And you'd be like, okay, what's the typical salary for that? Okay, 60 grand. Okay, I'll take that. But the main thing is you have to have some justification or process and that you keep in a folder of how you got reasonable compensation. You need to make sure you have documentation of it. I will say that talking to many people that are more experienced than me in the industry, that they have never seen it audited if someone took compensation, and as long as they took something. Now, I'm not saying that you have 200 grand in income and you take a $10,000 salary. I'm not saying do that, but like as long as it's at least a third that I've seen some people say, then you're typically okay. So that's something to think about. So all that to say, the S-Corp saves you in self-employment tax. And how you set it up is you create an LLC or you create a C-Corp, you make the tax election. You need to make sure you're running payroll, taking reasonable compensation, and then you want to make sure that you are filing the 1120S. That is the tax return you do it. You do not pay tax at the S-Corp level. It passes through to you you pay tax at the personal level. And another thing to note is that multi-shareholder S-Corps can get tricky, because if, say, I take a distribution, then that would mean someone else would need to take equal distribution, and it can get a little sticky. So we don't always recommend doing multi-shareholder S-Corps. Just have one and then go from there. If you do want multiple people owning one, a lot of times we'll be like, okay, we set up an LLC. Each owner has their own S-Corp that owns the LLC. So then you can just flow everything, expense everything out. There's a lot of fun games you can play, accountable payment reimbursement, forwarding your rent. A lot of things you can do to maximize your deduction as an S-Corp that you can't really do as just like a sole proprietor or something. So that's another thing to keep in mind. Next, we have the C-Corp. So the C-Corp is the most common one you see, like big companies like Apple, Amazon, Tesla. All these companies are all C-Corps, and all the big ones are C-Corps. And why is that? Because C-Corps are great for raising money and getting investors, going public. You have to become basically C-Corp to do that. You can have foreign shareholders as a C-Corp. There's more flexibility on the investment side, and really if you're trying to scale and grow big. A lot of our clients, we don't recommend that because they aren't trying to go public. They're, one-man shows, or, maybe a little more multiple employees, but it's small. They're just trying to save on tax. And C-Corps are great from the investor side, from a lot of liability protection, a lot of side. a lot of times. But the downside of C-Corps is that you can pay double tax. Like, so C-Corps do pay, like, unlike LLCs, S-Corps, sole proprietor or sole proprietors with an entity, but those you don't pay any tax at the entity level. This one, C-Corp, you pay, currently it's 21%. There's talks that might lower it, but we'll see. But 21% at the C-Corp level. So let's say 100 grand of net income at the C-Corp level. If you don't take that out, if you just leave it in there, then you're getting taxed 21%. So $21,000 you're paying it, which in a lot of countries, 21% is great. For Americans, we don't like to pay tax, and I get that, and that's what we help people with. So that can be sometimes a lot. But as you make more and more money, you realize, okay, 21%, a lot of people are like, okay, that's not that bad. Because yeah, you have 21% there, but if you take it out, whether that's through payroll as a dividend, then you have to pay tax at the personal level. So if you're a really wealthy person and you take money out as an investor or something as a dividend, then you've got to pay tax at your personal tax rates as that. So that's not fun either. So C-Corp is great for if you're going big, going public, even if you're trying to have a management company. Sometimes we'll set up management companies where the C-Corp can offer what's called a health reimbursement arrangement, where you can get reimbursed for health expenses that you can't in an S-Corp or an LLC. So essentially, let's say we set up a C-Corp just for this, and basically let's say you have an operating S-Corp that pays a management fee, you have a C-Corp help, I don't know, consulting fee, whatever. You send money to here, let's say $10,000, and then let's say you have $10,000 worth of medical expenses, whether you get MRIs or you have a tough year where things go bad. Well, you can at least get reimbursed for that, get a deduction, not pay tax, you get money in your pocket and you get a deduction for it. And you don't pay tax because it's a reimbursement. So there's the ins and outs of that. I'll probably make another video about just that. C-Corps, great for going big, going public. You do pay taxes twice if you take money out as dividends. If it's a reimbursement, you don't. So there's ways to get money out, but that's another option. But that is the common one that you will see for big corporations. Now, there are things to maintain it. You can really not be mixing personal business like you did with LLCs in the beginning. That's like totally, like, you don't see Jeff Bezos going and be like, oh, I need groceries. Let me use the Amazon card because I'm hungry. Like, it's totally separate. There's a lot of maintenance involved, like board meetings. You've got shareholders, especially the big ones. So yeah, that is like the top, or like when you're really getting big, you're handling other people's money. That's what you do. Lastly, you have nonprofits, which is like a totally separate thing almost. But basically, a nonprofit is a business, really. It can show profit. It can generate revenue. It can have income. And it doesn't pay tax. The purpose of the business is not to make money. It's for, quote unquote, a different goal. Now, people use nonprofits for, you could argue, for personal gain, even though they have under the shelter of, helping people. Like, obviously, you might have nonprofit restoration companies where they're going and they're looking for natural disasters to go get paid by insurance companies to help restore people's homes and buildings, which it is a valid need, and they can operate under the guise of, yeah, we are generally trying to help, and they probably are, but by default, they're also making money. The NFL used to be a nonprofit for a long time. NCAA was a nonprofit. IKEA is a nonprofit. So you have a lot of nonprofits that still make billions or millions of dollars now, and there's no technical owners of these nonprofits that get dividends, but you can still get CEOs with big salaries from these nonprofits. But how you set up a nonprofit is that you create a C-Corp, a corporation, and then you fill out a form to then you send into the government, a 1023, and there's the 1023 EZ, or there's the more longer form if you're going to generate more revenue, which it can take a long time. And we've done it before, but we recommend if you're doing the longer form, you don't do it by yourself. If you're doing the easier form, then it can be done. But yeah, you fill out this forms, you send them in, the government then says, okay, yeah, we see you as a nonprofit. And then you have to operate like that. And each year you have to file to make sure you maintain your status. And there's transparency on every year it's public, the total revenue you make, the expenses. And it generally should be for a good cause. So if you're going to set up a nonprofit, make sure it's, actual for reasons, not just trying to get around things. but it is a tool you can do, and we help people, especially start making more wealth. It's not that bad of an idea. But yeah, so those are all the different types of businesses that you've probably heard about in the US. Hopefully you've learned a little bit about each one and which one's best for your situation. Like I said earlier, the most common types are just sole proprietor, single member LLC, or an S-Corp. Really, those are the three that we see most with our clients and what we would recommend that just makes sense for their situation. Obviously, you can go really deep into each one of these, and we might in other videos, but thanks for watching, and I hope you learned something, and we'll see you in the next video.